All right, good morning, everybody, and what is today? Uh, it's Wednesday. It's Wednesday. That's what it is. It's Wednesday. We'll get started here in just a sec. Just quickly trying to find the chats here. Here we are. Perfect. You guys can hear me okay? Very good. Very good. All right. Mm-hmm. Okay. All right, I think we are ready to go. Let's see here. Okay, perfect. Yeah, as I was saying, good morning, happy Thursday. Serge Berger here from thestudytrader.com. We're going to get started right now with our morning call. We're going to spend the next 10 to 15 minutes going through some of the more important things here on the notepad. If you're here for the first time, welcome. Please make sure that you subscribe to the channel here. Obviously, it's free, but it allows you to be updated in real time when we go live and we have analysis, news, analysis and ideas and stuff like that, and research. Also, if you could please give us a thumbs up like on all the videos that you watch and maybe even leave a comment, that would be amazing because that allows us to be able to have the algos pick us up, and that of course helps us grow the channel, and so on and so forth. So that would be awesome. All right, let's see. We need to kind of start off with what we have been starting off with now for some time, which is the review of asset performance. I want to show you a couple things that are where we're seeing performance starting to get better. One stock and one sector, and they're obviously related. And then I want to show you something that I think is getting stretched, and it's a name that I think a lot of people are watching or at least have heard of before. It's one of those popular names that a lot of people tend to get giddy about. So we'll show you that. So let's get to it. So here is our asset performance year to date. Again, just a daily reminder, and again, I know a lot of people still don't care. We can tell because no one really asks or comments on it. I know they're still long Max 7 and only Max 7, and they're doing well. The problem is they're getting beaten by mostly everything else. Max 7 stocks, as a reminder, are up an impressive 19% year to date. Very impressive. The problem is that most other things are beating it, particularly hard assets. Gold miners, uranium, platinum, palladium. Platinum and palladium yesterday were both up meaningfully. Gold, silver, copper miners, emerging market stocks, European stocks, Bitcoin, Ethereum. That shouldn't be that surprising. So, there's a lot of performance happening elsewhere, while the headlines continue to be grabbed by AI companies that are basically buying other companies now so they can justify, somehow coming up with more growth. That's a dangerous territory to be in. I mentioned this yesterday quickly for those people that were listening. We actually didn't get any hate mail on that comment, which was surprising. I'll be open to seeing what happens if I mention it one more time. So maybe we get a few rolling in. But here we are. So that's the reminder. It just also be a reminder that the S&P 500 has a correlation of about 1 to basically 4 or 5 stocks. You all know those stocks. And so whenever those stocks stop going higher, whenever that is, and I'm not proclaiming that's going to be today, that's not the forecast, but once that happens, the S&P won't go higher anymore. Either mathematically, it's just not possible. It's just a reminder. At the same time, we want to continue to respect the trend, right? So that's the thing. It's more of a risk management exercise. So if you, and this is not financial advice, just educationally speaking, so if you are enjoying the write-up here, it would be very prudent, it would be sane to sort of manage some risk along the way. So I would certainly suggest one considers doing that. That's number one. Number two, let's look at some sectors. Now, one part of the market that we have been watching very closely, and it's actually doing, well, let me show you, you can see. So this is utility stocks. The utility sector most recently It's been in a bullish trend essentially since the early part of the summer, and they're gaining a bit of steam. They're up 5%. Utility stocks could do very well here because there's the natural gas story, there's the nuclear energy story. All that stuff includes utilities, and so we're seeing a pickup in performance on the part of utility stocks that I want to show you here. I'll show you one name that I think is interesting. So let me quickly just bring it up here. And we actually showed this one to our clients using the market rover. This is a company called WEC Energy. And I'm going to quickly show it to you here. WEC Energy is a utility company by definition. It's got about a 36 billion market cap. So it's a fairly large company. And I want to quickly show you what it looks like, first of all, from a trend following perspective. So from a trend following perspective, you can see this stock has been in a bullish trend now for some time. In fact, it went into a bullish trend all the way back in August of last year. So it's been in a bullish trend for almost 13 months. It's stock's up by 26% since then. So it hasn't had like a crazy move, but it looks like it's coiling here. So let me just show you the chart. So this is now, again, utility stocks look favorable in our view. Here's an individual stock from a research perspective if you would like to look at it. I'll bring it up, WEC Energy Group. And here's the absolute chart. Again, for those people that like to just look at the chart, I think there's two ways of looking at it. First of all, there's the more sort of multi-month chart. So that would be this one here. So you can see WEC Energy with yesterday's move where the stock was up not quite 2%. You can see that it is perking above. Now the bigger chart, which is this chart here, which is a multi-year chart, you can see that WEC Energy is also basically on the verge of, it kind of is now breaking out of a resistance area that the stock has been in for the past 5 years. So now you've got multiple time frames, and I think this is very, very interesting, and I would encourage everyone to would encourage everyone to be aware of. Third point I wanted to make was, so that's a view on the performance year to date of things. That's a utility sector highlight here. Here's one stock. So hopefully this alone should have been worth you coming here. So please make sure you subscribe to the channel. Please tell everyone you can about it. I think this is worth a lot, considering it's free, right, for the morning call here. I want to show you one stock that I'm extremely concerned about because I know people are chasing it. And that stock is IONQ. I'm going to quickly show it to you. So the ticker symbol is IONQ. This is basically a quantum computing stock. There's certainly a lot of potential there, but the company is like buying more and more other companies. And I think typically when you see that kind of behavior, it's a sign of them trying to justify revenue. So they're trying to find revenue by buying other companies. Our Vertical X Pro indicator, which is what you're looking at here. So I think everyone should have an indicator that tells you when something is either extremely overbought or extremely oversold. What you're looking at here is our Vertical X Pro indicator, and it's not just when things are a little bit overbought. It's like when it's crazy, extremely overbought. Doesn't mean the stock's about to drop. That's not the point, but it tells us that the reward to risk to buy the stock, all else being equal, is not very good. Does not mean the stock can't go higher at all, but it tells you the reward to risk is not very good. In fact, a lot of times it tends to mean revert. Not always, but a lot of times. So the last time we got an extreme overbought signal in IONQ, it dropped about 27% and then went absolutely nowhere for basically from May this year until just about 3 weeks ago. And now the stock's gone crazy, and you know, you can see it's getting more and more overbought. So we finally yesterday had a day when our indicator said, you know what, the stock may now be so overbought, or 2 days ago, may now be so overbought that it might start actually going lower or sideways. We haven't had what's called a follow-through down day yet, so we're still waiting for that. I'm watching it very closely. And so that's what we're looking at. Bobby's saying he's looking at a trade using next week's calls. Just so you know, Bob, for those of you guys that use the Vertical X Pro, we don't use options that expire near term because it can blow you up. It ultimately does blow up portfolios. We typically use options that expire between 55 and 75 or 85 days out, but then only hold the trade for two weeks or so. Using short-dated options is a thing. It's a thing that people do right now because we live in a gambling bubble. But I would encourage people, educationally speaking here, to not use short-dated options, particularly not for this kind of stuff, because it defeats the point of the trade. Because what one does is turn a high probability trade, right, into a total gamble by using short-dated options. There's a lot of really, really bad options education out there right now. I can't even call it education, right? So if you want to learn more about that, Bob, just get with our team. Joel here is in the chat. Joel, if you want to reach out to Bob, I don't know if you guys can somehow connect. He can to kind of teach you a bit more and show you it's kind of how we look at it. But I personally would not use short-dated options on this kind of thing. In fact, it defeats the purpose of what the setup is supposed to be. I know there's a lot of bad education right there, so hopefully that helps Bob. All right, let's see here. And then Pamela had a question. She's saying Mike Wilson, he's the gentleman from Morgan Stanley. She's saying interview this morning. I believe his interview was yesterday on CNBC. Unless you watch, maybe he was on again today. That's certainly possible. He said the economy was in recession for a while, and now it's coming out of the recession. Look, I'm going to tell you what my view is here right now in the broader scheme of things. I think we live in a gambling bubble, and I think it's very difficult to know. I think it's very difficult to know how things are going to play out from here, because this is not a traditional setup. We have inflation that's still running higher, like factually, and growth that's at some point going to slow down further. So even if you listen to Powell yesterday, and that's not necessarily my reference point, but he admits to that too, right? So I think my hunch is that we are at a point where a lot of people that are very bullish are going to be surprised by how bad things could get. That's my view. Am I necessarily, overly bearishly positioned? Not really. I'm hedged, but I'm not like crazy short because the market is continuing to trend higher. There are two things to this though, Pamela, or anyone else that, for that matter, that wants to hear about this. People think they can time the short term. And I'm not saying that's impossible. I think it is possible. The problem is that a lot of people think that they're going to be able to change their portfolios when things are turning. And they'll say, "Oh, I'll change it when things are turning." When things stop going up, they typically start with a big sort of multi-day move down, and then it's just done. And then it might not go straight down, but then it'll kind of continue. So I want to respect the trend, and indeed for all of you guys using the market rover, and certainly using our trend or momentum indicator, like factually, that momentum remains bullish. I mean, all you have to do is look at the trender. Here, I'll show it to you guys, right? So this is why we follow momentum. So this is, for example, momentum on the S&P 500. Momentum continues to be bullish. Like, that's just how it is. Do I agree with it? I couldn't disagree with it more, but it factually is taking place, right? So, I think a lot of people don't know what two-way price action and price discovery looks like anymore, and that's most people, and I think that's why a lot of people are going to have a horrible time for the next 5 to 10 years when their portfolios might lose 30 to 50%. That seems unthinkable right now for a lot of people, but I think that is going to happen for particularly a lot of people that manage the stuff. They're the bigger part of the money themselves because they've come into this complacency that they can do it themselves just because the S&P's gone higher, and the S&P's largely gone higher because we've had a lot of stimulus, right? Fiscal and monetary stimulus. The liquidity cycle, so fiscal and monetary policy globally, is currently forecast. Global liquidity is currently forecast to peak at some point in the first quarter-ish next year. The market's going to be looking forward to that, right? So the equity market, as short-sighted as it tends to be, it still tends to look forward 6 to 9 months. So at some point, and I wouldn't be surprised if it still happens this side of the calendar, of the yearly calendar, at some point is going to start looking at that end of liquidity coming, which might be when we start seeing the equity market starting to have hiccups. I don't know what the corrective move is. I think, look, Mike Wilson is trend following like all these guys are. You know, he's saying 5 to 10%. When someone like Mike Wilson, I'm not here to badmouth, I think he's doing a great job, right? But he's saying 5 to 10%. That's a statistical fact that mostly corrective moves in bull markets are 5 to 10%. That's all he's really stating, right? That's good and smart for him to say, but it doesn't take a genius to say that. And I get why he says it. I don't even disagree with him. What I'm saying is that 5 to 10% can very quickly turn into 20, 30%. I know that seems unthinkable right now, but I'm telling you, once the liquidity cycle ends, and it will end at some point, that will happen probably pretty quickly, and then the S&P might go sideways for 5 to 10 years. And then pretty much no one in the 401k or IRAs are going to make any money. So that's the current concern I have. However, factually, look at the screen right now. You can see that momentum, using our momentum indicator, remains bullish. The S&P, it's bullish. Like I'm not, it's factually there. So it's not like I'm fighting that. I'm just warning people that I think a lot of people are trading right now, be it short-dated options or some other fund, and picking up pennies and missing the big picture. That's what I'm deeply concerned about. I see it every single day. I talk to people every single day. I can tell that's what they're missing, and they're not making changes because things are still going up. And their thinking is that they'll be able to make a change quick enough once things change. I'm guaranteeing you right now, most people will not be in a position to change quick enough their portfolios because A, they have no help, and B, they don't know how, because an investment account is not a trading account, right? So we live in the world with the do-it-yourselfer in the investment world. I think it's crazy. I think do-it-yourself on the trading side is okay. I think do-it-yourself on the investment side, most people are completely living an illusion in terms of the ability to do that, because that takes a lot more, two-way, takes a lot more thinking and long-term and so on and so forth. So anyway, I'm going to get off my soapbox here, but I appreciate you guys listening to it. For those of you guys that are in trade ops, we'll see you guys in a few minutes. And Trade-a-thon starts in about 25 minutes or so. So thanks for being here. We'll see you guys back here tomorrow morning. Please thumbs up, like, subscribe to the channel, and we'll see you back here tomorrow. Take care.